We will tell you the 9 goals you should reach before your 60s. If you are able to reach these goals, you can retire peacefully. The last goal is very crucial to achieve, so watch this video till the end. Now let's start. Number 1. Settling unsecured debts. It is highly recommended to prioritize paying off any outstanding unsecured debts, such as the balances on your credit personal loans or student loan debt, as soon as possible. This should be your top priority. Consider implementing the debt snowball strategy to effectively tackle your debts one by one. If you're facing issues with credit card usage, consider cutting up the card and refraining from requesting a replacement. It's not advisable to have debt with high interest rates at the age 60 in your life. Take the necessary steps, such as implementing the envelope system if necessary, to gain control over your spending and overcome your debts for good. Number 2. Building up your emergency fund. It is recommended that adults have between 3 and 12 months worth of living expenses saved in their emergency fund. As you enter your 60s, you might find yourself desiring more. Emergencies can encompass various unforeseen circumstances such as health crises or job loss, which tend to become more probable with age. Having a larger cash cushion as you approach retirement can provide added protection against a potential market crash early in your retirement. This is commonly referred to as sequence of returns risk, and it's important to be aware of this potential danger. Holding a substantial amount of cash, planning for your retirement can help you steer clear of the need to sell stocks when the market takes a downturn, ultimately decreasing the chances of depleting your portfolio before the end of your life. It would be wise to allocate some additional funds to your emergency savings on a monthly basis. Having a clear understanding of the market can help you avoid making impulsive investment choices during a downturn, allowing you to stay calm and make rational decisions. If you want to know more amazing financial tips and secrets to get rich, then subscribe to our channel and also press the like button. Number 3. Consider discontinuing your life insurance payments. If your household relies on one income and has multiple dependents, life insurance is essential. If you're an empty nester, it's unlikely that you have concerns about retirement unless your spouse is unemployed and you haven't adequately planned for the future. Reevaluate your life insurance policy in relation to your current needs. Feel free to seek another perspective, just not from an insurance salesman. Consider consulting with a financial planner, or perhaps seeking advice from your accountant or a knowledgeable family member. If your dependents would face significant financial difficulties in the event of your death, it would be wise to consider life insurance. As you near retirement, it is likely that you no longer require life insurance and can save on expenses. Number 4. Take a moment to review your disability insurance. As you approach your 60s, disability insurance becomes less of a priority. Indeed, safeguarding against the loss of your ability to work is crucial, as the ultimate goal of retirement is to no longer rely on employment for income. Once more, it would be wise to consult with a financial expert if you are unsure about continuing to make payments for a policy. If you're close to achieving financial independence, it may be wise to forego it and allocate the funds towards retirement investments. Number 5. Understand the amount you need to save and make a budget. Have you ever considered the amount of money required after your 60s? If not, it is important to calculate it immediately. Thankfully, the calculations are straightforward. Carefully strategize your ideal annual budget for retirement, covering all aspects from living to transportation, food to recreation, holiday gifts to travel. It's a good idea to compare your planned budget with the main personal and household budget categories for guidance. If needed, You can create an entirely fresh budget from scratch using Google Sheets. Then calculate your annual budget by multiplying it by 25. That's the approximate amount you should aim for as a nest egg. Or not, depending on your projected lifespan post-retirement and your comfort level with taking risks. For more information, you can explore safe withdrawal rates or consult with a professional in the field. It's possible that you've already achieved financial independence and can sustain your desired annual budget solely through investment income. Or perhaps you still have a considerable distance to cover. Number 6, establish a desired age for retirement. After determining your desired savings goal, establish a specific age at which you aim to achieve it. Keep in mind that fluctuating financial markets can either accelerate your progress or hinder your momentum. It's important to remain adaptable, prioritize saving a significant amount of money, and be ready to extend your working years to some extent in case of a sudden downturn in the stock market right before your intended retirement. Additionally, it's important to be aware that your employer may not give you complete autonomy in making the decision. Older workers frequently face job displacement. More on that later. Number 7, consider your options for housing. Where do you envision settling down once you retire? In that spacious suburban home where you raised your family and had a beloved canine companion? Is a smaller home in the same city an option? Is it in another state, or perhaps even overseas? It is advisable to downsize sooner rather than later. Owning a spacious home with expansive lawns entails significant financial responsibilities, including hefty mortgage payments, utility bills, and ongoing maintenance expenses. It's important to move forward and focus on saving more money for your retirement. It could potentially assist in retiring a year or two ahead of schedule. As you're brainstorming ideas, it might be worth considering house shifting as a way to completely eliminate your housing payment. With no housing payment, you have the potential to retire at this moment. It may be worth considering a move overseas. There are numerous countries across the globe where one can lead a comfortable life with a monthly budget of $2,000. By reducing your housing expenses, such as utilities, repairs, and maintenance, you can free up more funds for retirement and potentially retire earlier. Number 8, explore opportunities for additional income after retirement. It's important to consider the implications of quitting your high-stress job without a plan in place. Let's start brainstorming some ideas for alternative income sources. Consider the possibility of reducing your work schedule to 3 days per week in your current job, or exploring new job opportunities that are enjoyable and fulfilling. You may discover a job that offers the flexibility to work remotely or a job that provides complementary travel opportunities. Several of these positions offer health insurance and additional benefits as well. Or it could imply having the freedom to work on your own terms. Consider exploring opportunities as a freelancer or consultant, or perhaps even starting a hobby business. Explore a variety of post-retirement job ideas and keep your options open. Discover a fulfilling and rewarding endeavor that offers financial stability, a sense of purpose, social connections, and the opportunity to savor life's moments. Working a second act can significantly alter the calculations for your retirement savings, the duration of your current job, and your choice of residence. You might even consider the possibility of leaving your demanding day job behind and embarking on a new chapter of your life right away. Number 9, make sure to plan for long-term care. We often dream of a peaceful passing, free from any health issues. Regrettably, the statistics do not support that notion. According to AARP, a significant percentage, 52%, of adults who reach the age of 65 will eventually require long-term care. One possibility to consider is long-term care insurance. However, it is worth noting that this type of insurance can be quite costly, and it is important to be aware that insurance companies have the ability to modify their policies and regulations. Now, watch the video appearing on the right side to know the habits of the millionaires which you don't follow. Also, subscribe to our channel to know the latest financial tips and tricks to get rich quickly. The video on the right side is very helpful, so watch it now.